Hey, what's up, everyone? We've got a fresh new update on the top 5 largest stocks that BlackRock is buying. This coming from their latest 13F filing to the SEC. And I'm going to run through these one by one, give you my quick opinion on each one of them, and I'll even rank them from best to worst too, based on that opinion. Now, BlackRock, of course, being led by CEO Larry Fink. It's the absolute largest asset management company in the entire world with many trillions of dollars in assets under management. Many people feel that they have really the most influence over the market right along with Vanguard. So it's always interesting to see what stocks they're buying. And in this case, these are the 5 stocks that they spent the most amount of money on this latest quarter. So let's not waste any time. Please hit that like button and subscribe. Really helps keep my channel alive. It means a lot to me. Thank you for that support. Let's go ahead and jump straight into this list. All right, now we'll be sorting these from smallest to largest position in the portfolio. And coming in at the smallest of the bunch, well, we have Walmart, ticker symbol WMT, which BlackRock has been really a long time investor in, adding another 38 million more shares of in Q3, bringing the value up to over $27 billion now, and yet that's only worth about half of 1% of their entire portfolio. That's how large BlackRock really is. Anyway, Walmart is, of course, a very popular stock for really smaller investors too, namely because of just how large they are themselves, with actually the most retail sales market share in the entire world. A lot of people don't even know that, but they're even ahead of Amazon. In fact, in the US, they do more than double the retail revenue of Amazon and about 3 times as much as Costco. That's a huge deal, guys. Now look, I have nothing against Walmart. I think it's a very solid, I would say, kind of overall stock for a lot of people, maybe the majority of the people in the market. They've got gigantic size. They have large warehouse-like stores around the world with tons of different products at very cheap prices. You go in there, you can find pretty much anything you need these days. And they're very popular to shop at. I like to, on occasion, visit a Walmart myself too. And the company even pays out a very small but very reliable dividend for anyone that does choose to invest in them, with the dividend yielding close to 1%, but over 5 decades of consecutive growth, which is technically dividend king status, hence why the stock has also performed extremely well long-term too. So nobody in Walmart stock has ever been disappointed with this stock. It's been a very good performer over time. However, there's a very clear reason why I don't have any interest in owning it myself, and that's because I see by far the most growth happening in their market, specifically happening with e-commerce rather than brick and mortar, which, to be fair, Walmart is trying hard, to expand in that area too, even in digital advertising as well, but it's just nowhere near the level of Amazon, who controls close to 40% of the entire US e-commerce market, while Walmart sits at just around 6% by comparison. And I own a really big stake in Amazon myself. It's usually a top 3 holding of mine in my personal portfolio, with also I have a much smaller position in Alibaba, but they happen to also command the most gross merchandise volume above anyone else. So I just feel that I get all the retail exposure that I need from really those 2 stocks, who are also much more diversified in areas of artificial intelligence, cloud computing, digital advertising, and a lot more, which is why they also have much higher growth, with next year's sales projected to be around 10% for each of them, which is more than double that of Walmart. And yet it's actually Walmart that has the much higher price tag, with over a 4 PEG ratio, whereas Amazon is less than 2 and Alibaba is just less than 1. And as impressive as Walmart's dividend growth history is, at only a less than 1% yield, it's not even close to keeping up with inflation. So it doesn't even really factor in, I would say, very much at all to my personal analysis on the stock. Again, I think Walmart is generally a good enough overall stock for a lot of people, and it also tends to perform well for them. But I'm just more excited about other stocks, other options in the market. And because of that, I will put Walmart around the middle at number 3 for now, until we see what else is on this list. Speaking of which, moving on to purchase number 2, well, we actually have one of my favorites, and that is in Broadcom, ticker symbol AVGO, which BlackRock added another 14 million more shares of in the quarter, bringing the stake up to over $60 billion and worth just a bit over 1% of the portfolio. Now, like I said, I've been a fan of Broadcom for a few years now, specifically for their work in developing custom chips for other companies, a type of service that I think couldn't possibly ever go away in the future with the rise of, AI and cloud and Internet of Things and all these new technologies. More and more companies are going to really not only need powerful chips for those areas, but also more importantly, customized chips for handling specifically what their business involves. So the demand for that, I think, will always be there. But another huge reason for why I invested in the stock was because of their massive $69 billion acquisition of VMware, which at first the market wasn't too sure about, but I argued that it was only going to make them even larger while helping them improve the other services that they provide, specifically in areas of AI and cloud and cybersecurity and others that really help Broadcom diversify as a business too. In fact, it's been so beneficial to them so far that Bank of America and Goldman Sachs even called them now their top 2 AI pick alongside NVIDIA, calling it a critical piece to the ongoing AI infrastructure build out, adding that the acquisition allows them to upsell different products and services to customers on either side, just kind of snowballing into more growth for them, which is exactly what we're seeing now with financials on fire, sales still growing by double-digit rates, and the stock has also skyrocketed by close to 500% in just the past 5 years alone. Unfortunately, though, for anyone not already in the stock, it means that you'd have to take on a pretty rich valuation at these currently high levels, where it trades about 35% more expensive than the sector on a forward PE basis, although I should note the PEG ratio is actually cheaper because of the incredible growth expected from the acquisition in future years. Still, it's probably not the most attractive, perhaps, stock out there after this climb, which also caused the dividend yield to fall down to just a bit over 1% now, which is something that used to be a big selling point for the stock, was that dividend. But I'm personally not buying any more shares at this time myself because I've already built out really the position that I want in this stock. However, I am still holding them long term, which is more than I can say for Walmart, who I have no interest in owning. So I'm ranking Broadcom higher at number 2. All right, now coming in at the third purchase here, well, it's a stock that I'll just tell you right now is gonna shoot up to number 1 because that is the mighty Amazon, ticker symbol AMZN, who BlackRock added 18 million more shares of, bringing the stake up to $124 billion and worth over 2.6% of the portfolio. And yeah, this one makes total sense, guys. Why wouldn't the world's largest asset management company also want to own the largest player in e-commerce and cloud computing, with even many other diversified offerings too, like in AI, EVs, gaming, and more? In fact, one of the more recent ventures from Amazon that I'm looking forward to myself longer term is in autonomous driving, with many analysts projecting the robotaxi market alone to be worth trillions of dollars long term. Well, a lot of people don't even know this, but Amazon actually acquired a robotaxi company called Zoox, which makes purpose-built vehicles specifically for the robotaxi market from the ground up. These are larger in size, almost like mini transport buses that you can even roll wheelchairs into, and they have no steering wheel, no driver, and are just 100% fully autonomous, which they've already started piloting a service across several major cities with a planned rollout and expansion into next year that will include paid rides too. Obviously, it's not anywhere near the top of the list of things that you immediately think about when looking at Amazon's business, but I just see it as more evidence of how dominant Amazon already is, and more importantly, how willing they are to enter new markets and try to dominate them in the future. And of course, we all know how popular Tesla stock is getting. Big reason why is all the hype in robotaxis. Well, Amazon is actually already doing that in their own way. Anyway, for a company this successful with giant sales and huge growth opportunity on the bottom line, which I'm really looking forward to, well, I couldn't care less about how much the stock has already risen. I'm ranking it number 1 on this list because there's very few stocks out there that could even challenge Amazon at this point. Well, moving on to purchase number 4, we might actually have such a stock. In fact, this is my personal largest holding in my own portfolio, and that is, of course, Microsoft, ticker symbol MSFT, which BlackRock added another 7.5 million more shares of, bringing the stake up to just shy of $250 billion at over 5% of the portfolio. Now, when it comes to Microsoft, it's obviously very similar to Amazon, in that this is another insanely large, very dominant company, lower in sales, but much higher in profits. Really one of the most profitable, well-run companies in the world. I think it's really the best at it, in my opinion. Of course, that is just my opinion though, but I love how they always invest in future growth while still managing to bring in incredible profits down to the bottom line too, which is not an easy thing to do, by the way. It's why so many growth-oriented companies either lose money or generate very little profits. But Microsoft is doing over 80 billion a year in net income, growing EPS yearly by 15% and still managing revenue growth in the double digits too. A big reason why is because of how good they are at expanding. We saw that with them buying up pretty much every gaming company out there recently. They also took GitHub for coding. It's going to be huge for the future. They took LinkedIn. Guys, LinkedIn is a giant deal. My girlfriend is actually a recruiter. You know, some of this is kind of anecdotal, I guess, but she was telling me, you know, she spends a lot of time on LinkedIn, and she was telling me how businesses and people spend thousands of dollars on LinkedIn just to have the ability to be able to send certain messages to other people and companies. It's really incredible. LinkedIn is a cash cow, mark my words on that. It's like the Facebook for job seekers and professionals and for networking, and it's only going to become an even bigger cash cow over time, just like Meta has done with their properties. And I think GitHub is going to be a similar situation too, but for coding and programming. And Microsoft is just so good at doing these things and sneaking them by people without them even like really noticing or paying much attention to it. Anyway, of course, there's other dominance that Microsoft has in AI, cloud, and business. Nobody can really match what they do there. And the only thing that I think really kind of holds people back from maybe investing in the stock is valuation. Microsoft always trades for a premium. It's even more expensive than Amazon actually by both PEG and about $1 trillion more in market cap. Even Apple and Nvidia actually are about $1 trillion higher than Amazon too, which I don't agree with myself. But Microsoft, I think you could make the argument for, just because of, you know, this being a stock that is so profitable and in terms of the company and is still growing at such a high rate too. Now, because of the valuation, it is a stock though that I would much rather buy very heavily, mind you, whenever it happens to dip, which is extremely rare, so you have to be vigilant for it. But I just think that at the current moment, Amazon might be a little more attractive at the current price tag. Amazon trades cheaper because the market is kind of looking at the current profitability, which Microsoft is better at. But if you consider the longer term, I feel that Amazon actually has a gigantic opportunity for huge growth on the bottom line. So you match that with the valuation, and it could mean better performance from here in terms of the stock price. That's just my opinion. Could be wrong about that, but I'm going to put Microsoft at number 2 and bump the others down one spot to fit it in, and I'm going to keep Amazon at the top there. That will, however, leave us now, though, with the final purchase of the list. This will be the biggest of all, and surprisingly, at least to me, it was Apple, ticker symbol AAPL, adding another nearly 43 million more shares of this past quarter, bringing the stake up to over $250 billion and over 5.3% of the overall portfolio. Now, the reason that I say this is surprising to me is for a couple reasons, really. Now, don't get me wrong. I love how sticky their products and services are. Feels like they have almost a cult-like following with their customers that seem to buy everything Apple every year. And they're making huge progress on services where most of the growth is coming from for them right now. You can see that on this chart here. Plus, they have one of the biggest cash piles in the world to ensure they'll never go away. They can afford to invest in any new technology they ever need to, while also buying back a ton of stock, something that always helps their EPS numbers and valuation actually look more attractive than it otherwise would. However, there's 3 big negatives for me to note. It's the most expensive stock in the entire world at over a $3.7 trillion market cap, which I strongly disagree with. I think there's several other stocks that should be valued more than them. And as for as much cash as they have, in my opinion, they're still mostly just a one-trick pony, relying very heavily on iPhone sales, with any trickle-down revenue from that, like in services and AirPods and Apple Watch, stuff like that, coming down into the business. That, don't get me wrong, that's not a bad thing. It is hugely profitable for them. And again, they're doing very good with services, but it's not all that diversified in my opinion. For example, you look at Google, right? They actually have more smartphone operating system market share with Android than Apple. And yet Android isn't even the first thing you think about when you look at Google's business, because they're so well diversified into so many other things that they do that are also even more profitable for them. And yet their market cap is like $2 trillion less than Apple. On top of that, Apple stock trades over 80% more expensive than the sector on PEG, which is fine when you're, that damn profitable. But it's also the second highest on today's list, with Broadcom being the cheapest. And I just feel that as a more long-term growth-oriented investor, I'm not as attracted to their almost flat performance on the top and bottom line, really these past 2 years that we've seen, but sometimes there even be negative growth because of the cyclicality of smartphone sales and how much they rely on that. Now, based on what I just said, Apple bulls might shred me in the comment section, but just know that I actually like Apple stock. In fact, I own some of it myself. The only reason I'm listing these negatives is to explain to you why I prefer other stocks a bit more at the current moment, like Google, Amazon, Microsoft, who are cheaper buys with more interesting diversified businesses, in my opinion. And by the way, I'm not the only one who thinks that Apple might be a bit overstretched here, as both Ray Dalio and even Warren Buffett have been huge sellers this past year. And Buffett is one of the biggest Apple bulls in the world. So in terms of ranking, I'm putting Apple at number 4. I know it's a little shocking there. Again, not because it's a bad stock, but only because stocks 1 to 3 are better options at the current moment, at the current valuation, in my opinion, which can obviously be wrong. But hey, that's just me. I'd love to hear what you all have to say down below. Do you agree or disagree with my ranking? Would you make any changes? Maybe swapping Apple with Broadcom at number 3? I could see that. I could totally understand that. But I just think Broadcom gets the slight edge here at the moment for the cheaper valuation and growth and other things. Anyway, thank you for watching, my friends. I hope you enjoyed the video. Let me know your thoughts down below in the comment section, and I will catch you in the next one. I hope you're all doing well. Take care, my friends. Bye-bye.